Thanks so much for joining me. Before we get started, please take a second to click subscribe to my channel to keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen for a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So, year to date, it's been pretty good for the market in general. The S&P 500 is up about 5% for the year as of early March. The real estate sector is also doing pretty well, not quite as good, but up over 3% for the year so far. But the communications REITs in particular are not doing too well. Crown Castle's down a little over 6%. American Tower is down almost 9% for the year. So joining me today is someone who knows a little bit more about American Tower than I do, Tyler Crow. Tyler, why would you say that American Tower has underperformed so much? And as a follow-up, would you consider investing in it, or is it a bigger problem?
It's a pretty loaded question because I think a lot of people would point to the general macro trends, be like, oh, well, higher interest rates and, demand for more because for the longest time, American Tower had a dividend yield around like 2%. It's like, well, why would I do that when the interest rates are so much higher? I can get better alternatives elsewhere. But if you kind of dig down into American Tower's numbers, there's a couple things that would justify why this is happening in a rising interest rate environment. Like, sometimes things happen because there are structural elements on top of those general macro figures. And this is where American Tower gets a little interesting. Number one, they have a relatively high amount of floating rate debt. Typically with most companies, you have most of it is a fixed rate debt, right? The weird words you always hear is senior unsecured debt, which basically means like we have a fixed rate. It's not, backed by any particular assets. It's just like we say we're going to buy, pay it back and we'll pay it back. And so that's where it's a little bit different, where AMT has floating rate, which means like as interest rates rise, their interest rates change immediately. It's not like when you have to refinance it a couple of years down the road, it's happening right now. And so with 22% of its debt outstanding being floating rate debt, that's a little bit of an issue. Another one they have is that a lot of the contracts that they have in the United States, with like T-Mobile, Verizon, AT&T, and stuff like that, they have escalators built into them saying like these are long-term contracts and every year they're going to go up by a set amount. That amount's only about 3%. It's not like tied to inflation or anything like that. And so at that 3% rate, that's losing to interest rate and inflation right now, and that doesn't look as good. Over those last 10 years when we were like 0, 2%, a 3% escalator looked great, but today, not so good. And then there's a little bit of I'm trying to figure this one out, but over the past couple of years, we've seen a bit of a decline in their rates of return. So in 2022, their return on assets was 2.86%, which, not great. 4 years ago, in 2018, they had a return on assets of 4.38%. So we've seen 2 whole percentage points drop in the return on assets in over a couple of years. Why this is happening, I haven't quite been able to drill down to it entirely, but part of it does have to do, I think, with that big data center acquisition. They paid a pretty hefty price for that, and then they immediately turned around and tried to find a joint venture for it to like secure financing and development money for it. So you kind of throw all those things together and then the weight of the macro environment, and it just doesn't look as attractive as it used to.
Yeah, and you mentioned the 3% escalators in a rising rate environment. Now, a guaranteed 3% rent increase year after year sounds pretty good, and it is. But when you think of what's happening in some other REIT subsectors where the operators can adjust rent based on market rates, like we've talked about a few industrial REITs where you've seen like 20% year over year releasing spreads. In self storage is another one that's you're seeing 20% releasing spreads. So a lot of investors are really looking for companies that can take more advantage of the inflationary environment, not just get hurt by it, like you said with the floating rate debt. So that makes a lot of sense. But the follow up question: do you think these are worth a look right now, or should investors just kind of let the interest rate headwinds play out?
I'm kind of the opinion right now to maybe just sit on it for a minute. Like to full disclosure, I own shares of American Tower. I've actually owned them It's probably my longest standing position. I've probably owned it longer than any other position in my portfolio. And so I don't have an issue with anybody like holding on to their current position. I don't feel any like reason to be hitting the panic button. But as far as allocating new capital to it right now, you know, I wouldn't be surprised if 6 months to a year from over the next year or so that there is a better entry point. And with, you know, money market rates at 4%, I think I can be patient and wait for a better entry point.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.